Hey guys, welcome back to another week of Mortgage Matters in Minutes. Again, I'm your host, Brent Rasmussen, owner of Mortgage Specialists. This week, we're going to talk about making high mortgage rates work for you and save. So, what does that really mean in regards to the environment that we're in, into purchasing a home, and to financial investments? And the topic here today is going to chat about higher interest rates and how does that impact you, or how does it impact the markets moving forward with real estate and or your financial situation. Of course, no one loves high interest rates or higher interest rates or any of the such, but are they going to happen? Sure. What I can tell you out of any of this that we're going to discuss is history repeats itself. Financial history, war history, political history. We can study these numbers and study facts that have happened in the past and possibly, if not for sure, predict what's going to occur because economic cycles repeat. They are on a repeat process. They're never going to stay the same perfectly. And while I would never advise a client to take a higher rate than they qualify for or what's out there, in many of individuals' minds, rates right now are too high. And I understand because we've been in a rate environment of 2-3% interest rates. Now, when we've doubled that from 5, 6, 7, and we were at 8% a few months back, yes, those rates seem much higher, obviously. We understand the anxiety when it comes to individual with interest rates thinking, wow, my payment is unaffordable. Things are much more costly, and they are. We're seeing inflation coming down and slowly coming down to get us back into more affordable range. But what defines a high mortgage rate? That's really not a true definition because high mortgage rates could be anything. And we've seen higher mortgage rates than we have currently back in the late 70s, early 80s. And obviously, the United States and the real estate environment got through those higher interest rate environments. But again, we would love to see interest rates come down. Borrowers love to see that happen. So would sellers, because the more activity that are out there for buyers, the better it is for sellers. What factors influence the mortgage rates and why are they high? Because we are seeing that inflation of cost of goods being more expensive than they've been. So the way that the government and the Fed can offset inflation is by increasing interest rates and hopefully slowing economic growth and slowing activity. So rates currently have been very volatile because every day we're releasing or we're seeing information being released that goes into what impacts the economy and mortgage rates moving forward. So from day to day, we can see rates jump as much as 0.25%. Is that normal? No. In a normal year, we might see interest rates change by as much as 0.25% over a whole year. But since the pandemic, we've seen interest rates be much quicker to the market with adjustabilities, even fixed interest rates, where we've had clients contact us and a week later rates are different and they're upset. Why is this factor happening? But let's talk about the key point of this video here now that we have a little bit of background. But making high mortgage rates work for you. Yes, they are higher. But here's what I would like to propose to you. Real estate values, generally speaking, continue to rise. And they will continue to rise because we have a massive supply and demand issue between how many properties are out there compared to the amount of people that want them. And those aren't equal right now. There are some studies that have been proven that we need 15 million more houses over the next 10 years just to break even. And there's no way we can build that many to keep up with what's happening. So my point to this video here today is to give a little education on where rates have been at. Yes, we don't like them, but I can share with you getting a property at some point in time is better than waiting. Just like investing in your 401k, even though the stock market might be going down, is still now is a better time than waiting because the numbers have always shown us and history has always shown that appreciation for homes is going to go up. Might not be every single day, but over time, housing is a long-term investment that fits into your financial plan. And even though we might see higher rates, getting into a property now while it's also continuing to rise, you have the opportunity in the future to refinance. Also, you have the opportunity in the future to possibly use your equity as it's increased to consolidate and pay off other bills and get rid of lower income or lower interest rate. Your lower interest rate on your home, get rid of higher interest rate credit cards and higher interest rate vehicle payments. Also, with interest rates increasing, savings accounts have increased. So you might have a different diversification of your entire financial portfolio to have it a little bit more conservative and moving to more of the more such guaranteed rate of returns or more conservative rate of returns with a more stable investment. So just because rates are higher on a mortgage doesn't mean the entire financial system, there isn't a way to make up those differences. I've seen a lot of clients move their monies from equities over into bonds and sitting on that right now. And later on, when the markets change, moving things back. So don't be completely scared of mortgage rates increasing. Still look at your budget and find out what real estate properties are within your means and go after those. People are still wanting to have houses. They're wanting to raise families. They're wanting to live in neighborhoods. And housing is still an important factor in all of that. So yes, rates are higher, but don't make that your sole reason, because I can share with you and have in other videos, as rates fall, we're going to see much more volume and activity of buyers in the market. And we're not seeing any changes with the amount of inventory that's out there. So it's going to get more competitive before it gets worse. So my goal of this video today, get property now if you can, and if you can afford it, and it's in your financial plan. In the future, you'll be able to make changes accordingly, possibly getting lower interest rates, taking advantage of that equity by using it to consolidate other bills, or selling your property and making a nice chunk of profit from that real estate property itself. We've seen lots of individuals still purchase properties these last couple of years, and they're still benefiting from that. Just because the rate might not be at 2 or 3% doesn't mean basic financial principles aren't still at work. Hope you learned a little bit here today. I'm Brent Rasmussen. Would love for you to subscribe each and every week and check us out here with our weekly Mortgage Matters in Minutes videos. I'm Brent Rasmussen. We'll see you all soon. Thanks. Mortgage Specialists. Driven, trusted, reliable.